live. The socials here. All right. Hello, Smart Money Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
How you doing, Kirk? Hey, how's that ice rink coming? If you were building it here in Minnesota, you could probably build it for the NHL at this point. We're about to hit arguably, not arguably, but they're predicting -18 going into the weekend, which would be the earliest this cold since 1989. Of course, they're saying that's also caused by global warming. So
everything's caused by global warming, but it doesn't exist anymore. It's no longer an existential crisis, according to Bill Gates and the Davos people. So apparently, it's no longer important.
That's true. But it's just current global temperatures now.
Everything's fine, Doug. After 20 years of brainwashing, everything's fine. Just ignore it. It's okay. Just look the other way.
It's exactly it. I don't know what. Here's the problem, though. And I know he's getting older and maybe he's already made his cheddar, but I'm not sure what Al Gore is going to do about this change because what else is he going to have a reason to live anymore?
So. He's made a boatload of money off of that movie and him being the PR person for this, and he bought a bunch of beachfront properties. I mean, he was doing the carbon credit thing. I mean, he's made a boatload of money off of that. So don't worry about Al Gore; he'll be just fine.
I worry about him all the time, Kirk. It's Al Gore's well-being keeps me up at night.
Politicians need love too, Doug.
they definitely need love. They know how to buy it. So
narcissistic, lying politicians need love too.
Yeah, I mean, nobody knows how to buy love like a politician. So.
I have to say, one thing that always made me laugh, and we'll move on because we don't like talking politics, is one of the big gripes that people had about Trump the first time is like, well, he's a liar. I'm like, so aren't they all? Like, are you mad because he's lying? Or are you mad because he's so obvious about it? Like, everyone else has lied since the beginning of time. That's why they're politicians, because they're good at lying.
It's not a good job any different than anybody else we listen to that's in a political position. He's just less smooth about his lying. Maybe that's it.
Well, you know what it was is I think the Democrats didn't like him because he represented us as a country, and they didn't think he represented them. He was too boorish, and he was too, common, and all the things that you want our president to be polished and perfect looking. Don't worry about the policy; it just needs to look good and sound good. And I always find that funny because we've had a lot of presidents over the history of the country, and we have one that sounds like this. And I'm sure there was one that probably sounded like this in the past. But at the end of the day, like, I think one thing that to take away from this is that people are craving authenticity. We live in a world full of fake
more than
bullshit.
ever now. More than ever.
We live in a world full of fake bullshit with influencers who are doing all this stuff and sitting next to Lamborghinis, even though they don't own them, and and all this stuff. Everything's fake. And now it's even worse with AI. You don't even know what's real anymore. People crave authenticity. And so when you have somebody who is authentic, like Trump, like him or hate him, we're not judging, just saying he's authentic. If you might say, well, he's full of shit. Okay, maybe he is. But he's telling people like what they're feeling, right? He identifies the fact that people are feeling in rough shape. They can't, Gen Y, Gen Z can't afford home. They can't afford to buy a home. They can't afford to feed their family. They can't afford to go on vacations. They can't afford to do all the things that the boomers did, right? The boomers had this perfect life. They went from everyone was kind of middle class, and all of a sudden everyone started to get elevated. People made a lot more money. If you had money in the market, it went up, and then tech and all this stuff. And boomers have lived in this extravagant lifestyle over the last 40 years because the markets have just gone up. And at the same point, Doug and I are Xers, and we're at the cusp of where things were barely able to do it. Like, you could do it, you could work hard and get it done. Nowadays, the younger generations, it doesn't matter how hard they work, they just can't keep up. I remember when I graduated college, I got my first salary was like 30 grand. Plus I got commissions. So it was like a starter thing they did in the training program at Payne Weber. So you got 30 grand plus you got like commissions, whatever you earned. And after like 12 months, you'd be 100% in commissions. You'd have to float yourself. They didn't float you, but they floated you for a year. And I remember friends of mine that graduated college, I had a high salary. And I don't think it was that high, but people were getting 20, 25. Like mine was pretty high. And not New York. New York was a different standard. But in Boston, I think I had one of the highest salaries. And it was paying Weber. They weren't paying, they weren't paying me too much. That was like the lowest thing they would offer. And so you think about that. I made it work. I got by, right? And I lived at home for like 2 years to like save up money so I could go rent and do other things and have more fun. But now what people are making, if they even get a job out of college, they're not making enough to go rent. I mean, God, the cost of rent nowadays, you got to have like 10 people in a 2-bedroom condo to be able to rent it. Like it's crazy. Like the economic divergence we talked about a week or two ago, the K-shaped economy, has gotten just nuts, and it's getting worse. The wealthy are getting wealthier, the poor are getting poorer, and the middle are getting squeezed out. They're picking one or the other. So if you've got assets, you're making money. If you don't, you're losing. And that's going to keep getting worse. And I think one of the interesting things is, Trump campaigned on addressing all these issues that people are really concerned about, right? And these are common. That's why Mamdani got elected mayor, because people are very concerned about economics. And Mamdani's solution is not going to fix it, but he's speaking to people's desire to have a good life, which they can't anymore to the same degree that we did and the boomers did and other generations did. They're not having the same quality of life. They want the American dream that they saw their parents have, and they're not getting it. They're frustrated, they're upset, they're pissed off, and they're voting for Mamdani. Okay, he's not a solution. We don't talk about that much in the show. He's not a solution. Socialism, that's never a solution. But it has a perfect track record of never working once. But it doesn't mean that people aren't gravitating towards it, and they do. And when social revolutions happen in this country or other countries, it happens because people are economically disenfranchised. Doug, did you have a question? I saw you raised your hand.
Yeah, no, I actually just posted a chart in there that it'll go really well with what you're talking about.
Okay.
It is young adults have given up on ever owning a house. Over 20% believe they'll rent for life. 60%, 60% have zero savings for a house. And the question, of course, comes to the housing inventory with the boomers. But, if you look at the percentage of people just since 2018, so this is from the Apartment List Millennial Homeownership Report by somebody. This only goes back to 2018. Let me look.
There's a different one I'm looking for.
I shift pages here. So
America's Housing.
Yeah, no, not that one. No, it's another one.
Okay.
Specifically about housing. But I mean, you just in the last 7 years, the amount of pessimism about ever owning a home ever again has just spiked. So
here we go. This one. No, it's a different one. Anyway, I don't know where it is, Doug. But yeah. So I guess the point is we all have scariest chart in the world. No, that's not it either. Anyway, we'll get to it. The point is we like to point fingers at people.
Here, I just put it in.
Okay. We like to point fingers at people. This politician's the problem. This person's the problem. This party's the problem. Well, it's actually none of those things. The problem is our economic structure is broken from decades and decades of people in power squeezing a nickel. Like, well, we can push it a little bit more because I don't want to lose money on my company, so I'm just going to squeeze a little bit here, squeeze a little bit there, and eventually people get squeezed out of what they think is right. Right? If you think about when I was back in the 80s, right, when Reagan was president, Reagan embarked on basically inflation, and we had a stagnant economy in the early 80s. Pretty much all through the 70s, it was stagnant. It went up and down a lot, and it was tough. It was a tough time. If you knew anything about it, any experience at all, go watch the movie Miracle, talking about the 1980 Olympic U.S. hockey team beating the Russians. It was a fantastic movie. I love that movie. It gives me chills when I watch it. But anyway, at the beginning of that movie, there's a whole.
Of course, it's Minnesota. But
yeah, it's okay. Minnesota. Some of those guys did their part. But but if you watch the first minute or two where they're doing the credits at the beginning, it shows like little clips, little video clips of what it was like gas lines that are like a mile long, and you can't get gas unless you have an even number in your license plate, like that kind of stuff. That's crazy. And we all kind of got through it, and times were different. People didn't have a lot of money, but you kind of got through it, and it was okay. People weren't super wealthy. And then the 80s hit, and then we embarked on a lot of inflation. House prices went up a lot, asset prices went up. And so inflation was embarked on, and it made the economy better. It made people's assets go up. People felt wealthier. All of a sudden, Reaganomics works because, hey, look at all the things we're doing. Well, it's basically inflation. And what they did was they took tomorrow's what's the Wimpy from Popeyes thing? I'll pay you tomorrow for a hamburger today.
Yeah, I'll gladly pay you tomorrow for a hamburger today. Something like that. Yes, yeah. Exactly.
So it's the same thing, right? I will gladly pay you tomorrow for an asset boost today. And so
I'll gladly pay you Tuesday for a hamburger.
Yeah, I'll pay you Tuesday for a hamburger today. Yeah. So basically, if you think about our economy, it's based on leverage. It's based on debt. Well, debt is basically borrowing future earnings. So if you're buying a house, I just bought a house 2 months ago. I could have paid all cash, or I could get a mortgage. Now, if I paid all cash, I would have to save up a lot of cash, right? That's untenable for virtually everybody. Like most people can't save up that amount of cash to buy a house. So, I can't do that, but I could pay you in 30 years for the house today, right? And so, what do? I pull forward my future earnings, right? I pull forward the next 30 years of earnings every month to pay a mortgage on this house so I can live here today. That's what we all do if you own a house, right? And what we've done is we've basically taken that template and done that with the entire economy. Is we've taken the entire economy and we pulled forward future earnings to today. And we're all benefiting from this. But at some point, the bills due. At some point, you got to pay your bill. So the U.S. government has levered itself to the hilt to keep the economy flowing and keeping everybody feeling good and keep the adrenaline running. But at some point, they can't do that anymore. And at some point, everything blows up. And at that point, everyone's in a whole lot of pain. But until then, hey, let's keep partying like it's 1999. And that's unfortunately some of the challenges that we face. Sorry, I forgot to put this up there. So that's some of the challenges that we face now is where is that line? Where's the line where you can't borrow anymore? Now, we may never hit that line because we're the global reserve currency. Other countries do have a line. Ours is a little bit more murky. But what I can see is I can see the global financial system resetting. And what that looks like is TBD. So a lot of you think you know what that looks like. I can tell you, I guarantee you don't know what it looks like. Because the only people who know are the people in power who are creating it, and even they don't know. They have an idea, and I have an idea, but I don't know. So don't be too certain about what you think is going to happen. There's certainly a lot of gold being acquired right now by central banks around the world. So
silver. Oh, I'm sorry.
No, they don't buy silver.
No. I'm just looking at silver prices,
Yes. Yeah. Well, not today, but but gold has been going up for a while, and silver was lagging, and then it caught up. But central banks buy gold, not silver, and so gold's been going through the roof. Why? Well, if the global financial system's going to melt, and if you know that there's a plan in place to change things around, what would you do? You would start acquiring a bunch of gold. Gold is a what do they call it? Tier 1 asset. So it's 100%. Typically, bank tier 1 assets are things that are as good as cash. They're basically guaranteed, and there's no risk. They consider it like no risk. So U.S. Treasury bills or cash are basically no risk. Well, now they've considered gold no risk. Well, if they consider gold no risk, then why wouldn't you just own gold? Because it's not paper. Gold is worth something. Paper is not worth anything. So I can see a global reset coming in the next 20 years. I don't know when, but I could see it coming, and you want to be prepared for that. And one way to be prepared for that is to own assets. Another way to prepare for is, like own assets like real estate. You could own assets like gold. You could own companies. The thing you don't want to own is bonds. Now, I'm not saying go out and sell all your bonds. It's not what I'm saying. I'm saying that if we do have a global reset, bonds could potentially be thrown on the pyre of the debt jubilee if we have that, which means that you could lose some or all of your money. So we're far from the debt jubilee, just to be clear. So if you're afraid and you're going to go get rid of your bonds, don't, because it's not going to happen tomorrow. It's just we're way too far away from that. That will only happen when it has to happen. And there'll usually be a big, significant event to cause them to push that. We're not there. So don't worry about it. At some point, we will be, but not yet. So, don't use this as investment advice. Just keep in mind that this is a thing and you're going to need to be mindful of it. So anyway, I'll give it back to Doug, but I just wanted to point that out there because we're in a point where things are going to start to get squirrely. The Fed lowered rates the other day, lowered it 25 basis points. So we're 3.5 to 375 as the Fed funds rate, which virtually every single person believed would happen. I think it was, I want to make one more point. I'm going to give it to Doug.
It's your show, Kirk. I'm just here to look good.
I know. You're the eye candy, Doug. A little under the weather today. I'm far from eye candy. So if you think about, where was I going with that? You just disturbed my thinking, Doug. I keep thinking about how
now you're looking at me and you just get flustered. I get
where was I going with that? Just lost my train of thought. Maybe we'll just have to give it up to you. That's where you just blink your eyes at me, Doug, and you got me all flustered.
I know those puppy eyes. Listen, if if it's that the same thing I always say to my kids, if it was that important, it'll come back, right?
That's true. We'll come back to it.
But I do want to say this. I thought this was a really good, interesting, and I admittedly I didn't audit this, but I would hope that the basic math in this wasn't was easily done. A gentleman named J. Rod Money on X posted this and said, and you can show it if you want. It's the last thing I think I put it in there. Hopefully I'm staying on top of my my shares. Yes, there you go. Let's say you make $100,000 a year. You spend $140,000 a year, which we can start by saying that this is probably not a good start. You owe $720,000 in credit card debt. We're not talking mortgage debt here, not amortized, just straight interest minimum payments. And you pay $22,000 a year just in interest, which, by the way, seems very low to me. But then again, if you think about the interest rates that some people get really good interest rates. Well, congratulations. That's the U.S. national debt if scaled down to a normal person. Now, interestingly enough, Craig, I like your thought on this. It doesn't actually sound as bad as I thought it would. I know. Don't get me wrong. Saying you make $100,000 a year and spending $140,000, that's the problem. But when I saw that it only kind of equated to $720,000 in credit card debt, which is absolutely astronomical, don't get me wrong, on a $100,000 a year salary when you're spending $140,000, but let's face it, that is in line with what a lot of people have gone out in the last 3 to 4 years and purchased houses for, amortized, right? So you owe basically a small California house with $22,000 a year in interest, which, if I did the quick math on that, say 22,000 divided by.
It seems incorrect, Doug.
It does seem incorrect. That's why I'm trying to figure this out. Now, like I said, I didn't do that. That would be a 3% interest rate, which the federal government, they get low interest rates. I got to think, and again, I didn't audit this, Kirk, but I would think that this could have come off of debtclock.org, which would be a very, very simple math divided by the number of people in America. But either way, let's just put it this way. It does scale it down to the stupid that this is not a problem that it is going to continue to exacerbate. I think, as I said, I'm not really concerned about the debt. I don't think anybody should be really concerned about the debt. The debt itself is not a problem. The problem is that they're not doing anything to make it better. The problem is that they keep adding to it. Like if the debt was at a point where the United States government just was able to cap it, like they weren't going any further and they were just working to pay it down, we still have, without question, one of the most powerful GDP forces on the planet and plenty of opportunity with the American economy to be able to attack that in a way that it would be something that would be on the books kind of like Elon Musk or a lot of the billionaires out there, as we've talked about. Why do they not pay any income taxes? There is so much bad information about why billionaires don't pay income taxes. First of all, most of them don't take a salary, or a significant salary. They are paid in stock shares and grants, which of course, when vested, they would be, they would be subject to some tax on. If they're still in a CEO position with their company, most of them just have the original shares that they had. That now is subject to capital gains. And as we know, you don't pay any tax on capital gains until it's sold or you die, and it's a step up. And and this is something, of course, that's in the, if anybody's been reading it, this is a hot topic right now. Congress wants to once again, or throw out rhetoric around taxing unrealized gains, which is a disaster. You can't do that, because what if, you tax you on these realized gains and then all of a sudden it falls? There's no wealth. There's nothing until you liquidate it to be taxed on. And so what do these billionaires do? They borrow, and they borrow extensively because they have the borrowing capacity to do it, and they have the assets to back it up. Elon Musk is not going to go out there and liquidate his SpaceX stock, which, by the way, they're now talking about going public on. I don't know if you saw that in the news, Kirk, the next couple of years. I mean, it's rhetoric, right? We'll see what happens. I don't personally know why Elon would want to deal with public shareholder scrutiny. X, obviously is wrapped in under his private holdings, but then you've got Tesla, which he's had tons of scrutiny, and he, just finally got his approved pay package, which again, by the way, he'll pay tax on that. So there you go. There's taxes. But ultimately, if he's going to borrow against these holdings and they're going to pay on that debt, there's no tax on it. So they are leveraging against their assets. So coming back to my point, the federal government effectively is doing the same thing. If the federal government has immense wealth in assets, think of what our government actually does own in terms of land and resources and future tax revenues, etc. Well, it's just not really a billionaire mindset would say, why waste the money to pay that down when you can use that money to invest in other things and enhance the economy? I'm not saying this is the exact perfect recommendation, but it's absolutely a good argument. The problem here is the 140 on 100. Okay, if you don't have that checked, then eventually the debt that you're still maintaining on becomes astronomically more difficult to manage, to maintain. And how are they going to do that? Well, that's the big rub, because if we're talking about birth rates out there and there's mixed data on that, okay, what are future tax revenues going to look like? What are the working, those that are working and producing taxes able to do in terms of tax receipts? What is our economy? Well, obviously there's the argument now. Trump is very confident that the tariffs have helped the deficit. Who's really paying that? Well, that's up for debate, right? Is it foreign countries, or are we just paying it? And it's effectively, passed a higher income tax on us. Although it's a consumption tax, in a way, if that's passed through. But ultimately, I don't look at this debt thing as being as being the problem. The problem is the deficit and continuing to add on to that debt, because at some point, as you just mentioned, it gets to the point in which it's unmanageable completely. And of course, as long as the full faith and trust is there, we're fine. If that erodes, then and of course, that's something I don't know if you saw in the news in the last week. But again, it's all rhetoric. But now there's the talk of these countries retaliating by dumping U.S. bonds.
Yeah, that's
exactly bullshit. Right. These are ideas and things and threats that are being thrown out there. If you take it at a surface level, if it were to actually occur, yes, it could be catastrophic. Would it actually occur? Well, people that are saying this don't understand how catastrophic that also is to those that currently hold the bonds, right? Because if they start to let me ask you this, Kirk. Let's just say you're the majority shareholder of Apple stock. And let's just say there weren't rules around majority shareholders having to liquidate in segments, which there are. You can only liquidate so much because the federal government wants to limit the ability to move the market, right? Take that away. You're the shareholder of Apple. Or you have a number, you and a collective of people are the majority shareholders of Apple, and you all decide to dump Apple at the same time. Would that be good for you?
Well, no, nobody. That's why they don't do it.
That's why they won't do it. It's why
Right.
this rhetoric is absolutely insane, because if they dump the bonds, they're the ones that were profiting off the sale. They would literally tank the value of their sales. It would implode their economies. It's absolutely foolish. They are just as stuck in our debt as we are.
Right. Well, if you notice what's happening with China, because people have been talking about this for a while, and the Pentagon's done war games with economic war games, which is interesting. And so, what you realize is you hear all this talk from the bobblehead media that doesn't really know anything. And honestly, if you're watching the media, just know that the newscasters and the writers, they all the quality ones left long ago. The ones there now are just basically talking heads. They're not really knowledgeable anymore, because they used to do investigative reporting in the New York Times and other places. They fired them all because it's too expensive. So the media has changed. So most of the things you hear are BS. Now things like that, I'll kind of talk through this a little bit because I hear this a lot. And if there's a lot of investors that get newsletters, and the newsletters are generating fear. They freak everybody out. Oh my God, buy silver or the US dollar is going to go to zero tomorrow. And there's a
We don't
guy
disagree with having silver, but for different reasons.
yeah, I mean, there's a guy out there who's I won't say his name, but you probably
Does his
know who I'm
last name
talking
start
about.
with an S, Kirk?
It sounds with a
Yeah,
something
exactly.
like that.
Yep.
And he's very pro gold and pro silver, and he's been pro gold and silver because he sells it. But he's also telling you to short the markets all the way up for like the last 15 years, which means you will lost a ton of money. But he's just, he's a broken clock. He's right twice a day, but he's broken the rest of the time. And when you hear stuff like this and say, oh well, the paper's worthless, the dollar's going to zero. And I heard this 2 months ago because I had clients calling me, should we get out of the dollar? Should I put all my money in euros? I'm like, no, it's fine. Just relax. The dollar.
Just a rule of thumb: you should never do. Should I do anything extreme? Like let's just all put that as a general rule of thumb for all advice out there. Dump everything, buy everything. Never right. Let's just
yeah. I mean, it's rarely a good idea, and if it is, I've probably already done it. Like if it was really that important, we would have taken care of it. But it's a good question.
Dump Enron. Get out of Enron.
Yeah, but it's a good question though, right? Because I want people to ask questions because that's how you learn, right? And so, when you think about it, so the Chinese and other countries have a lot of our debt, right? And you say, well, they'll just dump it all. Well, yeah, dumping it all would hurt us, but it would hurt them too. And then we would buy it back, or somebody else would cheaper. So it would just be stupid, And so it's not a really good strategy. But what they are doing is they're letting it mature and they're not buying more. So they're basically letting it run out, right? So they've got all these bonds and they slowly mature over time, and eventually they all pay off and they just don't buy more. So that's a strategy to disconnect from us, which is fine, right? And if they want to do that, it means we have to find another market, another buyer, which I know Bessent is working on right now, and that'll be interesting when that's revealed in full. But I think the thing to think about is there are plenty of losers if you start having tactical nuclear war with the economy, right? If you're trying to nuke the economy, everyone dies. So there's no advantage to somebody doing that. So it's a mutually assured destruction strategy. If you're really trying to tank our markets, your markets are going down too. So if you want to do that, good luck, because it's like the global financial crisis. What happened? Everybody bought that crappy paper. The whole global economy melted down. Everyone owns stuff that other people own. It's all interconnected. It's not isolated anymore. You can't have economic targeted warfare because it impacts both sides. So I think that while it sounds good and it's scary, it's really not a practical use case to think about when it comes to investing. Now, I do want to give you something practical. Here was this week when the Fed decided to lower rates. Okay, when the Fed announced the S&P, and this is basically 4 charts. It's the S&P 500, silver, the 10-year, and then the dollar. And what you'll notice here is when the Fed lowered rates, the S&P 500 shot up, I don't know what percent, but it shot up maybe 0.5%. But anyway, the direction was up. Silver shot up, right? That went up sharply as well. The dollar dropped quite significantly, and the U.S. Treasury dropped significantly. So what does that mean? Oh, I'm sorry, the yield dropped, which means the price went up. So if you look at this, what do you take away from this? Well, you could say the problem with some of these things when news is announced, sometimes there's an initial reaction, and then there's the reaction a few days later. The initial reaction is done by algorithmic trading, high frequency trading, and it's usually done based on wording and all this other stuff. It doesn't necessarily mean directionally it's going that direction, but many times it is. So you could look at this and say, all right, well, the S&P, this would indicate that the S&P is probably going to go higher based on this decision. It means that silver is probably going to go higher based on the decision. The dollar is probably going to go lower, and the 10-year is probably going to go up in price, down in yield. Now, it's good to do this once in a while, just so you have a sense of how things react to news. And that's why I wanted to show it, not necessarily that directionally that's where things are going to go, because I'm not sure. But you want to do it just so you have a sense of when news comes out, how did X react to the news? So if earnings for Apple come out, have a chart before, after, show like Microsoft and other competitors, and get a sense of like, all right, this news came out. How's everybody interacting? So when NVIDIA came out, it was like big news 3 weeks ago when they came out with their earnings. Like the whole market was waiting on NVIDIA. Is NVIDIA going to melt down, or are they going to go through the roof or whatever? And how's the market going to react? And it turns out the market reacted poorly. And it was good news, but the market didn't like it. So the markets went down. It's good to understand that thinking. Like, how is the market considering this? What are they looking at? That's how you understand the market. It's not, well, they came out with good numbers. Why did it go down? That's those stupid Wall Street people. Like, no, it's because the sentiment on the stock is different from the reality. So if they came out and beat earnings by 20% and it went down, it's probably because the analysts thought it was going up 40%, because the expectations were different from reality. So even though the news is good, people don't invest on news. They invest on future expectations of whatever happens in the future reality, if you will. So that's really what's really important about this, is to understand that you're always thinking in the future, not today. And I thought here's something that I'm trying to pull up the chart here. Here we go. So if you're thinking about the future and not today, here's what you want to be looking at. Now, here's a chart. I saw this, the market cycle clock, and I haven't digested it yet, so forgive me if I'm doing it in a disservice. But the concept of this is to understand the economy and the markets. So on the vertical axis, it is the inflation, and on the horizontal axis, it's growth. So this is a correlation between inflation in the economy and growth in the economy. So if we're having GDP growth, is it in the highest, what do they call it? 3. It's not a quartile. It's what is it?
Third?
Yeah, a third, I guess. See, I told you, Doug, I'm not feeling well. So the top third.
I was trying to ask myself, is that a trick question?
I feel like there's another word for it. Anyway,
so the top, it's in thirds. Yeah, first, third, second, third.
Yeah, quartile, quintile. Anyway, I thought it'd be something else.
I don't think it's the tertiary. I don't think that works.
Yeah, I don't know. My head's swimming. I've just been up all last night, so my head's not working properly. But so the top third of growth is the bottom left, and the top and the bottom. I'm sorry, I reversed it. So the bottom third of growth is in the lower left. The bottom third of inflation is at the bottom. So you have the lower left is low inflation, low growth. On the upper right is high inflation, high growth. Now, here's what you want to think about. What these colors and the numbers in the box are average monthly returns, or average annually monthly returns is what it looks like. actually, I would say annualized returns and then monthly below. But anyway, these are the returns in the boxes on average over a 50, 60 year cycle, looks like. 70-year cycle, sorry. So if you look at this, the upper right, high inflation, high growth means you have a very low return. Okay, it's 2%. If you have high inflation and low growth, you're getting 5%, and mid growth and high inflation is negative. But if you look at the lower left, you have low inflation, low growth. That's actually lower left, and then the one in the lower middle. Those are the best returns. You have 15.29, you have 16.11%. So the point is, as you're looking at this, if you have an environment where you have low inflation and you have an environment with low growth, why would you get the best returns? Well, here's why. Because when you have low inflation and when you have low growth, what does the government try to do? The government wants to stimulate growth. How do they do that? By printing money and flooding the system with liquidity, which raises asset prices, which causes asset prices to go up, and everyone makes a lot of money. Okay. Now, if you have high growth and low inflation, you're still doing okay at 12.25%, but not as good as if the growth is lower, in part because of the government money and the stimulation that it does to stimulate the economy. So just think about this as you're thinking about market cycles. Most people think, well, inflation's going to impact the market. It does to some extent, highs worse than low. But the economic growth is really largely irrelevant. If you look at this, it's really not that impactful. It is a little bit, but I have to say, this is fascinating to see this data. I never look at GDP growth. I think it's all bogus because I don't think it's accurate. Because it'd be hard for them to calculate properly, but also because there's a bunch of government data in there. Is that the economy? I mean, technically it is, but I don't see that as a good indication of the economy. So I haven't looked at GDP in a long time. I know a lot of people who don't touch it because it's just a meaningless number. But the government tries to tout it as, oh, we're doing well, we're not doing well, whatever. I just think it's bogus. It doesn't help. It's not helpful. There's a lot of government data that's not helpful. That's one of them. Inflation is helpful, but it's not accurate. So, i.e., it's not helpful because it's not accurate. But anyway, I just want to kind of share that because I think that, when people are looking at all these indicators of what's working, what's not, you have to understand that a lot of this data is really not useful. But I do think that as we get into, seeing if I can find, I think that's the only chart I had. But as we get into this part of the year, we have 3 weeks left of the year. And of that 3 weeks, the last week is the Santa Claus rally, as they call it officially. But people call it the Santa Claus rally in December, really the last week. But here's the thing. I said this last week. I'm going to say it again in case you didn't hear it. The takeaways for the next few weeks are this. Look at the market. Do a filter for the whole market, really sectors more than anything else. So what I would do in this time of year is I would filter. I would get all the sectors, whatever 8, I forget how many sectors there are, 8 or 10. Get all the sectors and make a chart of how they're doing for the year. Get a list of commodity prices. Get a list of foreign countries' markets, and aggregate all those ETF names. I'm assuming you're using ETFs for simplicity purposes. So grab all those tickers and put them in a big list and go through each chart, okay, and see how it's doing. Now, what I would look for are sectors that are doing really well, and I would look for sectors that are doing really poorly, okay? And here's why. The sectors that are doing really well, some people might want to cash in the gains. Not many, but some might cash in the gains and say, hey, I want to take some money off the table. A lot of funds will keep it because it makes them look good, makes them look like they were in it the whole year when they have great returns. Some people even buy it at the end because they want to look good to their shareholders, which is what we call window dressing. But, just keep in mind of what the top performers, and then look at what the bottom performers are. And most people do this in January. but it's not helpful in January. Because if you're doing it now, you can identify stocks for 2nd of January when the markets open up. Because here's what happens. At the end of the year, there's tax loss selling. So people go through their portfolio and they say, ugh, these restaurant stocks have been dogs. They're down 80%. They're crap. I got to, dump these things. And so what people will do is they'll sell their position in these crappy stocks, wait 30 days, and then buy them back. Well, what happens is everyone's dumping the stock. They're just trying to get out. Get me out of this dog, whatever. And so what they'll do is they'll dump it. They'll suppress the price way further than it should, which allows you to buy it at a low price. And then come January, everyone says, oh, crap, this stock's down a lot. I got to buy it. It's a good company. And they start to acquire it, and it turns the cycle. I'm not saying the cycle is going to change. I'm using restaurant stocks as an example because they are beat up quite a bit. We've talked about that. And, they could be the darling of next year just because they got beat up so much this year and because it was less bad next year. I don't think that's going to be the case. I think restaurant sectors got a long way to go because the average public doesn't have the money to spend, which is part of the problem. But if you look at that and say, where are the opportunities? The opportunities were beat up, didn't work so well. Right now, areas that are doing well, biotech's doing great, Latin America's doing great, Israel's doing great. Look at all these sectors that you think are just going to go into the crapper, and yet they're not. Like, you got all the chaos going on over in the Middle East, and Israel's doing great. Their markets are all-time highs. You got Latin America, where we could send in frigates and aircraft carriers there to attack Venezuela. Latin America's all-time highs. You've got all these areas that you think, oh, they're terrible, but they're not. And international has done very well this year. So look around for areas that are subpar, they're not doing well, and just watch. You don't have to buy them on December 30th or 31st. You can wait till January. You can see if they're going to pop. But frankly, I would just buy a bunch of stuff on December 30th or 31st that has been beat up way more than it should. And I would buy it and I would just hold on. And if the beginning of the year it continues to sell off, okay, I'm out. I was wrong about that. But I'm willing to take the shot because the downside risk is really low because it's already gotten beat up. People have already sold out for the tax loss selling. At some point, they're going to buy back. So I have a lot less to lose. So it's a very low risk, high opportunity trade. That's why I like things like that because, a few years ago, we bought Bitcoin and Ethereum at December 31st. I forget what year it was, like 22 or 23. And it was at the low point. And I only bought it because it had been beaten up so much. I was like, well, I can't go down much more. Let's just buy a position. And it was very fortunate. That was literally the bottom. December 31st of that year was the bottom of that of those investments, and it went up from there. I didn't know it was going to be the bottom. It was scary. Everybody was freaking out about those things. And they're like, oh my God, they're going to zero. And the talk was really negative. Turn around next day, it's off on the races. So these are the games that Wall Street plays. I've done this many times over the years, my personal account, just playing around. You should consider this for your portfolios. Look for areas that are potential possibilities. And even if you miss them, look in the first week of January, see where the money's flowing, because the money's going to go to certain areas where usually people feel like they're underweighted or they sold out and they want it to go higher. Look there too, because if you're seeing a disproportionate amount of money going into a certain area, keep in mind, because January money is really hot money. Now, if the markets start to sell off in January, be afraid, because that's not a good sign. What do you got, Doug? I know you just sent a bunch of charts here. You want to talk through those?
Yeah. Well, it's just a little bit more about that Santa Claus rally and how it goes into January. I thought this was good to continue on it. This is some information that was posted by LPL Financial. They do some really good research. Going back to 1950, the Santa Claus Valley percent return every year is generally it's all over the place, but the average has been about 1.3% for the month, which, again, if you look at it on an annualized average and took that, over the course of the year, that's a really good month because you're looking at almost, 13, 14% annualized return. If we take, look at that a little bit further, what we can find, and I thought it was, because they also go into the average January return. And by the way, and you kind of mentioned the Santa Claus rally, and that end of year effect actually goes into the first couple of days of January. It's where you really want to watch, how things have have evolved, and ultimately, why there might be some questions as to kind of how why this does what it does, and there's been a lot of theories to try to explain it, including holiday shopping, general season optimism, the fact that institutional investors are on vacation, which has generally led the market to be bullish. But once you get into January, the first 2 trading days of January have shown, I hesitate to say proven, but shown to be an integral part of the Santa Claus rally, tying it to broader January market patterns, including the January barometer. And when you start to get a trifecta when you start to look at the Santa Claus rally and the performance in the first 5 trading days of January, they call this the January trifecta, because it includes multiple indicators, including Santa Claus rally, January barometer, etc. When they're positive since 1950, the market has ended the year 90% of the time with an average gain of almost 18%. So this is extremely powerful, historic indicator to really watch, like you were saying, going into it. The other thing to keep in mind is, what does it look like when we follow a really good year? Because this year has been well more than 20%. We hit that 2 years in a row. How does it typically look when we've had a plus 20% year? This is where there's a little bit of a little bit of an indicator as well. But generally, when we've had a 20% year, and we had a 20% year 2 years ago, and then we followed it with another 20% year, very positive, is generally the next year also tends to continue to have that momentum. We look at like 19, and this is not every year, but there's if we look at 1954, 45%, the next year was 26. In 1958, it was up 38. The next year was 8. 1995, 34, 20. So I don't have the average here, but the worst following years that happened, and it wasn't, every one of them wasn't always great. 1989, 21, 55, 1980 were all under 5%. 1955 and 1991 were positive, 2.6 and 4.5% respectively. In 1989 and 2021, it was down 6.6% and 19.4% respectively. And 1980, it was down 9.7, and 61, it was down 11. But these are probably, I'm looking at the quick math on this, but that's probably about 1/4 to 1/5 of all the years that we've had a 20% return, where we've ended up with a negative following year. Now, this is really important for people that are watching this and listening, is that does not mean the next year is without volatility. Every one of these years ended up with a fairly significant drawdown in the middle of the year. So, volatility is not a bad thing. It is actually very, very normal. This is something they teach you in when you look at investing. It is actually very normal to have significant double-digit, up to double-digit drops in any given year and still end up positive. Now, the good news is that in most of these 20% return years, the max drawdown of that following year was under 10%. We've had, we've a lot of 7%, 9%. There were a handful that were down double digits, as much as 25 to 34% drawdowns at some point during the year. And yet, this is interesting, of the years that had the max of the significant drawdown, one of them was down 33.8% in 2019, ended up the year 16.3% up. Most of the years where we had double-digit drawdown of that following year, you ended up with a negative return. So if we do get into the double digits, that tends to not be great. Now, there's also a negative 15, 16% drawdown in 2009. It ended up 12%. But most of these years kind of averaged between 7 and 9% drawdown. So that means that there's, look, that even if we end up positive, just expect it's probably going to be a period of time during the year that we're going to have some sort of a pullback that will, that will not indicate that the sky is falling. It just indicates that we need to be patient. The last thing that I wanted to say on, in this too, is that ultimately, if there was a, if we look at the years in which the Santa Claus rally failed to call, there's a saying that, it's just, gentlemen, as Yale Hirsch put it, if the Santa Claus should fail to call, bears may come in to Broad and Wall. And ultimately, when investors on the nice list, meaning they're positive that there was a positive Santa Claus rally, and Santa delivers this positive rally, the S&P has generated an average January return of 1.4% and an average following year of 10%. It compares to the retrospective of an average January following a negative. So if we have what they call the naughty list, when the rally was negative, you're looking at a January return of negative 0.2 and an end of year of 6.1. Following a negative Santa Claus rally. So still, even if the Santa Claus rally doesn't come to fruition here in the final days of December, the average return the following, in January was slightly negative, although albeit mostly break even, but the following year still ended up positive on average of 6.1. It's just, if we can rally into the end of this year, it is a great positive sign going into the following one.
Yeah, I agree. I agree. I think the important thing is to be mindful, and you're going to see a lot of data this time of year where people are excited and they send you a lot of data points and, oh, this is going to happen. This is going to happen. You got to keep in mind about all of it, right?
Nothing's going to happen. That's the thing you need to remember when you're watching. Nothing's going to happen. It's things could happen. Always keep perspective. These opinions are very black and white to get you to react and to focus and to click. But you have to look, as you're getting into, Kirk, you have to look deeper.
Yeah. So I think just keep in mind this time of year, just be mindful of that. And, I've given you some tactical strategies that you can consider. Ultimately you have to do the research. I'm not going to do the research for you. You got to go figure out what ones work for you. We certainly do it for our clients, but we have to keep some of the stuff for them. So, we tell you a lot of the good stuff, but not everything. So I would say just do some homework, look at it. Is a very low risk way to target it. I got 1 foot in and 1 foot out right now. It's the markets. December tends to be a positive month, but at the same time, it kind of feels a little heavy. And, they just lowered rates and the markets celebrated and then they've sold off today. So, things kind of feel heavy. And could they change that? Yes. But at the moment it feels heavy. So when you have that heavy feeling, sometimes you just got to step away and just say, all right, I don't have an edge in this game and I'm just going to wait. And so all of you should think about it that way. You don't have to be in the market 100% of the times. I know what Wall Street tells you. You don't have to. Just wait for an opportunity that works for you. If you feel unsettled, then get out and wait. International markets have been great. You don't have to invest in the US. You can invest in international too. There's lots of opportunities abroad. So anyway, we're going to wrap it up here, Doug. So take us home.
Yeah, listen. I love what you just said, because there's a lot of people that put out the charts, Kirk, that always say that if you missed the the best days of the year, look how bad your return is. What you don't see as much is, look how good your return is if you miss the worst days of the year. So when you say it's not always a bad thing to be out of the market, that's absolutely that's absolutely not true. There are times in which you want to be able to can check yourself, look at things, and take a step back and breathe. As we mentioned, this is something that we're kind of winding out this year. Like Kirk said, the markets are down a little bit. With the turning of the current market right now, but we're not into those last days of the year. So we're going to have to see what happens as we get into Christmas beyond. Those final days of December is when it really works. People get distracted by the Santa Claus rally. There's this idea that the markets are going to magically rise because it's December. But smart money understands that it isn't a gift. It's a stress test. Right? This is all stress tests. Strong year-end markets don't mean a coast is clear. And a weak rally is historically one of the biggest warnings for signs for the year ahead. With today's worst market breadth on record leverage, commercial real estate stress, and AI that is definitely hollowing out entire job categories, this is not the moment to run your wealth on autopilot, especially if you're affluent, because the bigger incomes and bigger portfolios also come with bigger exposure, bigger taxes, and bigger drains on it if you're not strategic. And this is why retirement income planning and college planning and anything that matters to you financially today must look nothing like accumulation years, nothing like when you start to give your money away, when you're starting to go into needing to use your money, it's got to look different. You got to have more margins of error, not just market optimism. You need a delivery truck of predictable income, a silo that protects the next few years of spending, a haystack that produces income first and growth second, and you need a field that you only harvest when the markets give you good weather, not during locust season. And the part that most people miss is that college planning also fits right into that same framework. So if you're still funding college the old way, like hoping markets cooperate, leaving your 529s exposed 5 years out, or believing high income protects you, you're ignoring one of the fastest growing threats to generational wealth. College costs hit the affluents harder than anyone else. It's after tax, and it's generally at exactly the wrong moment. And if you're paying out of the field when the markets dip, well, that's how wealth quietly evaporates. The families that win, whether it's retirement income or college funding, are the ones who are going to stop reacting to the headlines, start building a strategy. They're going to use the tools that map out every dollar's job, stress test the plan against surprises, and adjust for the world we live in now, not just the world we grew up in. So I'm going to ask everybody listening directly, have you actually stress tested your retirement income against today's risks, not yesterday's assumptions? Have you mapped out college expenses and how they collide with retirement? Have you run the numbers on what happens if the markets deliver this weak Santa Claus rally and we end up with a truly volatile year ahead? If that little voice in your gut is saying, I'm not sure, you need to listen to it. That's your margin of safety calling. And if you're the type of family who wants to stay in control, wants to play offense instead of defense, who wants to plan like smart money does, reach out. This is what we do every day at Mergent Advisors and Mergent College Advisors. Because wealth isn't about surviving the next rally. It's about building a plan that works no matter who's in the office, whatever the Fed does, or whether Santa shows up at all. Check us out, mergentadvisors.net. That is MERGENT, mergentadvisors.net. At that site, you can also learn more about our college planning services and college funding services, Mergent College Advisors.
Awesome. Well, thanks for coming on, Doug. Always love your metaphors. Thank you for those. Mix it up this weekend. That's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just make your we don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.